Hi guys, a very good afternoon to all of y'all. Today we'll be looking at a very small minor concept which is known as investment property in your IAS 40 standard, right? For most of y'all, this standard might be quite new, right? Let me be honest with y'all. This is a very easy, simple standard that can be tested in your financial reporting paper, right? And if you all ask about the weightage, this can be tested in your section A, this can be tested in your section C as well, right? In terms of A, this will be tested under MCQs for 2 marks or maximum 4 marks, that will be two MCQs, or they could ask for you from your company accounts as an adjustment, right? Depend on the examiner's mindset, right? But before we dive into the topic, I'll let you know this topic is an easy and a standalone topic, right? If that is so, let us start off our today's session, which is IAS 40 investment property. Now, hopefully my screen is visible. Let me let me try to cover up this entire standard in a way that you all will be able to understand. Right? Let me narrate a story. That would be fine. Okay. So what we know, what we have learned so far is that initially, right, in our foundations of ACCA, in our various academic qualifications that we've had so far, we've learned a standard called as IAS 16, property, plant, and equipment. Right? What did that particular standard say was if a business, if a business is using the asset, it could be land, building, any of the tangible assets. If they're using that for 100% business purposes, see here, 100% business purposes, right? It could be to produce your goods and services, or it could be for your business administrative purposes, right? As long as you as a businessman, your intention to use that asset in your business, then you could use the standard called as IAS 16. This is all what we know, right? This is all what we know. This is basic and this is foundation, right? Later, subsequently, what happened was the IASB, International Accounting Standard Board, they came up with another standard called as IAS 40, right? IAS 40. Now, you all might be thinking, why do they need to come up with a different standard? Well, for that, I would say what happened was, what happened was, what happened was simple. The intention changed. In IAS 16, your intention was to use that asset for your business purposes. IAS 40 came up with if you have an asset, if you have an asset with the intention, let me change the color of the pen. If you have an asset, right, with the intention of earning rentals, right, you all know, right, you can give a building, you can give an entire building or a part of the building for a third party and you can generate rental income, right? If your intention is that, then that would be treated under IAS 40. That would be treated under IAS 40. It would be treated under IAS 40. Second one, this is first one, and the second one, to earn capital appreciations. Now, what is capital appreciations means? See, a real life scenario, right? What happens is, your fathers, your parents, your grandfathers, what they do is they buy a building or they buy any tangible asset, right? Say they bought it 3 years back, right? When they bought that asset 3 years back, the asset's price was about 300,000, I would say. Now, today, the market value of that asset is about 800,000. So can you see that 500,000 has been increased? That is called as capital appreciation. Your asset is value is increasing, right? So that is why they came up with a standard called as IAS 40. Again, what does IAS 40 say is if you have an asset, if you have a building, if you have a land, if you have an office with the intention of giving it to a rent to a third party, number one, or number two, you having that asset to generate capital appreciation, then what you need to do is you can treat them under IAS 40. You can treat them under IAS 40. So this is the difference between IAS 16 and IAS 40. In simple terms, IAS 16 says is if you have an asset for its business purposes, then 100% you can treat it under IAS 16. IAS 40 says if you have an asset and your intention is not to use for business, your intention is not to use for business, if you want to only generate rental income by giving it to a third party on a rent or a lease, or number two, if your intention is to earn capital appreciation or increase in the value, right? Then you need to use this standard called as IAS 40, right? You will be using IAS 40. You see, you will not, you will own the building, but you cannot use for business. Obviously, right? When you give it out on rent, when you give it out on rent, obviously it will be given to a third party, right? And he will be using it for his own business purposes and not for your business, right? So that is what you need to know. And what you need to know. Okay. So earlier it would have sounded in Greek, right? Because I was just telling a story. There was no pictures, there was no numbers. Okay. So I have come up with something, an illustration, right? Which would even more broaden your knowledge in terms of IAS 40. Okay, so I've brought in two situations. One is situation number one, situation number two. Let us look at each and everything precisely. Okay, so in situation number one, this is a building. Okay, I have drawn it. Consider it as a building. The building's name is Phoenix, right? And it is eventually owned by a person called as Mr. A, right? What Mr. A does is he's using this entire building. He's using this entire building for his business purposes, right? It could be used to produce goods and services, or it could be used for his administrative purposes. Okay. So if a business is used, if an asset is used for business purposes, right, then we need to follow the rule of IAS 16, right? We'll be following the rule of IAS 16. This is what we know. This is what we know, right? Now, moving on to situation number two. Look at this. This building's name is Alpha, right? This is an Alpha building and it is owned by Mr. C, right? But I would say Mr. C is a smart businessman. Look what he has done. I have mentioned number one, number two, number three, number four, and number five, respectively, is to categorize the number of floors, right? So there is about totally five floors. What Mr. C plans to do, or what he intends to do, is he's planning on owning the first three floors, which is marked in orange, right? And the last fourth floor and the fifth floor. What he's planning on doing it, he's planning on renting it to a third party. He's planning on renting it to a third party. So then you all might be thinking, how do I do an accounting for this? It's simple, guys. It's simple. It's simple. Can you see here this first, second, third floor? What is the intention? It is to use for Mr. C's business purpose. If so, you all need to treat it under IAS 16, property, plant, and equipment. Fourth floor and his fifth floor. What was his intention? He's planning on giving it on rent to a third party, right? He's planning on giving it on rent to a third party. If that is so, his intention is to earn rental income, right? If his intention is to earn rental income, what you need to understand is This will be treated under IAS 40 rule, right? This will be treated under IAS 40. So this is the difference between an asset that is under IAS 16 and an asset that is under investment property, which is IAS 40, right? Hopefully, you all are clear with this concept. Okay. So let me move on to our next part. Now, don't worry, this is not complicated at all. It's not complicated at all. You all will be able to easily understand. Now, we've learned something, right? Yes, it is. We've learned something. If an asset is used for business purposes, we treat it under IAS 16. This is our first standard that we've learned since foundation, right? And today we learned another standard. If the asset, if the asset is held for rental or for capital appreciation, we use a standard called as IAS 40. This is the second standard, right? Everything depends on your intention. Everything depends on your purpose, on what are you planning on doing with that asset, right? Now, third one, if what do you think if an asset is kept as inventory, right? If an asset is kept as inventory, for an example, take real estate business. Take real estate business. What do you think is the inventory of a real estate, right? What do you think is the inventory of the real estate business? The real estate businesses will have inventory such as lands, buildings, leases, office premises, shops, huts, whatever you call it, those will be treated as inventory. So if any asset is held as inventory, right, that will be treated under something known as IAS 2. That will be treated under something known as IAS 2, right? This is also we have learned. Okay, this is also we have learned. This is our third standard, right? Simply remember real estate and you all will be able to come up with the idea of how you implement IAS 2, right? And there is another interesting topic, right, which you all will be learning in a bit, right? That is called as IFRS 5. That is called as IFRS 5, right? What does IFRS 5 says is, if your intention is to sell the building, right? You're not planning on using for business, you're not planning on renting it out, you're not planning on keeping for capital appreciation. But if you're planning on keeping the asset to sell and generate an income, then you need to treat it as IFRS 5, assets held for sale. Right? Don't worry, that's also another small topic that you all will be learning. Right? That's also a small topic that you all will be learning. Right? So these are the different standards that an asset can be utilized. It could be utilized in terms of IAS 16 if it's used for business. It could be utilized in terms of IAS 40 if it's used for rental income or capital appreciation. Or number three, it could be used under IAS 2 inventory. How come? If your business is dealing with real estate, where your assets are land, your inventories are land, building, office, freehold, premises, all of those will be treated under IAS 2. Final standard is if you have an intention of keeping the asset and only to sell it, right? There are some people, they buy the asset at a low price and they sell it at a higher price, right? Then you will be using a standard known as IFRS 5, right? You will be using a standard known as IFRS 5. Okay, now we'll move into our final part, which will be the accounting of IAS 40. Okay, so you all need to understand that there is two types of accounting, right? First, you need to initially measure the asset, and then you'll do something called as subsequent measurement. Right? This is what we learned in PP16 as well. Okay. Always, always, regardless of whether it's PP16 or regardless of whether it is IAS 40, always your initial measurement would be at cost. Right? This applies to both PP16 as well as for IAS 40. It could be the direct cost or directly attributable cost. Okay. So that would be your initial measurement. Okay. Now we come into something called as subsequent measurement. Right? In terms of subsequent measurement, there are two models that can be used for IAS 40. One is your cost model and the other one is your fair value model. Now, during your MCQs, right, examiner will tell which model you are required to use. Right? So you all don't need to worry about whether am I supposed to subsequently measure it using cost model or the fair value model, because this will be provided by the examiner himself. Okay. So let us first look into cost model and then move on to our fair value model. Okay. So what happens is, first of all, you will recognize the asset. After that, you're planning on hitting it onto your statement of financial position and statement of profit or loss. Right. So what you'll do is initially you'll measure it at cost, and then subsequently you'll move into either cost model or your fair value model. Right. Now we are choosing cost model in case if examiner tells. Right? What you need to do is it's just quite simple. At each reporting date, right? At each reporting date or at each financial year, you just simply need to find out the carrying value. Right? You need to find out the carrying value. Okay. So obviously you all know how carrying value works out. It's cost minus accumulated depreciation, right? And in this cost model, right? In this cost model, what you need to understand is depreciation, which is an allowable expenditure. You can charge depreciation if it is a cost model, right? And the logic behind that is quite simple. Look at this. You need to find out. You need to find out accumulated depreciation to arrive at carrying value, right? So then obviously you will be needing depreciation cost, right? You will be needing depreciation cost. And finally, the third point, say during your financial year, right? You will be comparing your carrying value versus the market value or fair value, right? If there's any difference between your carrying value and the market value, that will be taken to your other comprehensive income or statement of changes in equity, right? So this is what happens in terms of cost model. Every year, you will be calculating your carrying value, right? Depreciation will be an allowed expenditure. Why? Because to find out carrying value, you need accumulated depreciation. So that's well, depreciation is an allowed expenditure, right? And at each reporting date, if there is any gain or loss, that gain or loss in terms of revaluation will be transferred to your other comprehensive income, right? These are the three steps that you are supposed to do in terms of a cost model, right? I have brought in an example. Look at this. Your carrying value on 1st April 2001 was 100,000. Your fair value is 130,000, right? So there's an increase of 30,000. Where do you need to go and put it? You'll go and credit other comprehensive income. Why? Because it's an equity account, right? You'll go and credit your other comprehensive income. Where will you debit? You will be debiting your investment PPE, right? You will not be debiting under IAS 16 property, plant and equipment. You will be debiting separately. You will be separately showing it under IAS 40 investment property, plant and equipment. This is how you are supposed to show, right? This is how you are supposed to show in your presentation, right? This is how we differentiate in terms of recognizing whether it's an IAS 16 asset or whether it's an investment related asset. right? Since this is related to investment, we are showing it under IAS 40. Okay. Now, moving into the best part. Now, this fair value model, it is, I have seen majority of the time examiner test this, right? So that's what I have put a star mark. Each and every time examiner has a habit of he would like to test your with fair value model, but it does not mean that your cost model would not be tested, right? But there are rare cases that also was tested. Okay. In terms of fair value, in terms of fair value, you don't need to calculate, you don't need to calculate carrying value and all. There is no need for you to go and calculate carrying value, right? And in this particular case, in this particular case, in this particular case, your depreciation expense is not allowed, right? It's simply think logically. If you don't need to calculate carrying value, then what is the purpose of you charging depreciation, right? So therefore, you do not need to calculate depreciation, right? So you might be asking, what do I do in terms of fair value? It's quite simple. Every year, at every end of reporting date, you will be given a fair value, right? For example, let's take this example. Let's take this example. Look at this. On 1st 4 2003, your fair value is 100,000, right? Your fair value is 100,000. And on 1st 4 2004, which is your closing date or closing reporting period, it has gone to 165. Can you see here? So the gain of 65,000 will be debited to IAS 40 investment property, plant and equipment, right? That is a fact. But now you need to understand the difference. In the cost model, what we used to do is we used to take any revaluation gain or loss to other comprehensive income, right? But in this, if you are using fair value model, if you are using fair value model, any gain or loss would be taken under other income or other expenses, right? You need to take it under other income or slash other expenses, right? This is what I have written here. Look at this. Any revaluation gain or loss will be taken to P&L, right? Under other income or other expenses. We do not go and show it under statement of changes in equity, right? You all need to understand and you all need to know how to differentiate the accounting treatment when it's cost model and the accounting treatment when it's your fair value model, right? Okay. Now, let us put what we learned into practice, right? Let us put what we learned into practice. Okay, so I'll give you all a minute, pause your recordings, your respective recordings, and you all have to read this question before you all start attempting, right? So what happens is Celine, right? She is investing in a property which is worth of $1 million on 1st January 2001, right? And they are telling the intention of this purchase is for investment purposes only, right? Now, this 1 million, that 1 million chunk they have invested, right? That consists of 400,000 worth of land and 600,000 worth of building, right? Okay, reading on. The building estimate has a useful life of 50 years. Okay, so building has a 50 years useful life, then obviously we need to check whether we need to calculate depreciation or not. Depends on the model that you are planning on using. Okay. At 31st December 2001, I guess this would be your reporting date. Can you all see here? 31st December 2001 is your closing year end, right? Local property indices suggest that the fair value of the property has risen to 1.1 million. Okay. Now, they are asking, show the accounting treatment if it's a cost model show the accounting treatment if it's a fair value model. Okay. So let's do the cost model first of all. Let's do the cost model. You know the cost on 1st January. How much was it? On 1st January, it was 600,000. That is basic, right? And since y'all are using cost model, we learned in this accounting, here see, depreciation is an allowed expenditure. Why it will be an allowed expenditure? Again, I'm repeating myself because you need to find out carrying value. Look at this. So how much would be the depreciation? 600,000 would be the cost. These are basic, guys. 600,000 is the cost. You divide it by 50 years. Per year, you will get this. You'll get a depreciation, annual depreciation of 12,000 rupees. Right? So obviously, to arrive at carrying value of the building, you need to cost minus accumulated depreciation, and you will be arriving at a figure of 588,000. That would be your carrying value of the building, right? And then second component of that 1 million was 600,000, which is the land. You all know land does not depreciate at all. So you all can simply take, that 400,000, right? They're asking, now the question says, we forgot to find out. The question says, how do you present it in your financial statements? This is how we present it. This is how we present it. We know for that relevant year alone, there was an annual depreciation of 12,000. So that you need to show under your expense, right? And in terms of balance sheet, right, under a non-current asset, right, you'll be showing your land and you'll be showing your building, right, which we arrived. I'll put this as working. Right, and this would be shown under, guys, you all don't go and show it under EPE 16 assets, right? Because that is a separate accounting treatment. You all need to show this in specific under, show it as like this: investment of land, investment of building, something of that sort would be ideal, right? Don't go show it under PPE because PPE is used for business purpose, right? This is how you do if they are asking you in terms of cost model. This is how you do it. Okay. Now, if they ask fair value model, right, you don't need to calculate depreciation. It's just a one line step. Just remember one line step. Okay, what you need just simply need to do is, here see, on 1st January, when you purchased it, the fair value was 1 million, right? During your closing year, the fair value is 1.1 million. Can you see the difference from 1 million to 1.1? There's an increase of 100,000, right? Where will you go and put that 100,000? Here, see, where will you go and put that 100,000? That 100,000 amount. That 100,000 amount, you can go and show, since it's a gain, it's a revaluation gain, you can go and show it under your investment income, right? That is what we have done here as well. You see, I have told we do not depreciate under this model. Always, if it's a fair value model, we do not depreciate. The gain will be taken under other income, right? So this is how we present it. You see, 100,000 was the gain. From 1 million, it jumped up to 1.1 million, right? So you show it under other income as investment income, right? And in terms of balance sheet, it's simply you take the fair value at 1.1 million. Under your non-current assets, you need to show it under investment, property, plant, and equipment, right? This is a simple basic stuff in terms of accounting for your investment property. There are two models, right? There are two models. One is your cost model, one is your fair value model in terms of subsequent measurement, right? I would say cost model, You have already learned it in your foundation, right? It's the same thing that you all use in IAS 16, right? Fair value model, just what you all need to do is simply look at this, simply compare the opening fair value and compare the closing fair value. If there is any gain, revaluation gain, if there is any revaluation loss, you all need to charge it in your profit or loss under other income or other expenses, right? Hopefully, this is fine with you all.